Hey everyone, welcome back. Today we're jumping right into one of the biggest stories shaking up Hollywood, the massive merger between Paramount and Warner Bros. Discovery. Now, whenever a deal this huge gets announced, the biggest mystery isn't about the next blockbuster movie. It's a much more basic question. How in the world do you figure out what a company like Warner Bros. Is actually worth?
Okay, just look at this number for a second. $110 billion. That's the total enterprise value we're talking about here. I mean, it's a number that's kind of hard to even wrap your head around, right? And that's what makes the job of pricing it so incredibly high stakes. You get it wrong, and literally billions of dollars could just vanish.
So that's the big question. And to get an answer, the board at Warner Bros. Brought in the heavy hitters over at JP Morgan. They asked for what's called a fairness opinion, which is basically where they pay the experts to do a super deep dive and tell them if the price on the table is fair for their shareholders. So today, we're going to peel back the curtain and see exactly how they crunch the numbers.
So here's our roadmap. First, we're going to see how Warner Bros. Measures up against its competition. Then, we'll look back in time at what similar companies have sold for. After that, we'll get out the crystal ball and try to predict future earnings. Then we'll put the whole puzzle together, and finally, we'll poke around for some of the hidden cracks in all this math. Ready? Let's do it.
All right, first up, judging by the neighbors. This one's actually pretty intuitive. Think of it like this. If you were going to sell your house, what's the very first thing you'd do? You'd look at what similar houses on your block sold for, right? Well, investment bankers do the exact same thing, just with giant corporations.
In finance speak, this is called a comparable company analysis, or just comps for short. The bankers find a group of similar companies that are publicly traded and look at financial metrics like their revenue or their EBITDA. Now, don't get bogged down in the acronym. EBITDA is just a fancy way of measuring a company's core profitability. They then figure out a multiple, like, say, a company is trading for 8 times its EBITDA. Then they can take that multiple and apply it to Warner Brothers numbers to get a ballpark value.
And what's really smart about what JP Morgan did is they didn't just treat Warner Bros. As one giant blob. They broke it down. They looked at a whopping 16 different companies across 4 different buckets. So for the big diversified media part, they looked at Disney. For the movie studio, they looked at Lionsgate. And for the streaming service, well, they looked at the king, Netflix. But notice they used a revenue multiple there, not EBITDA. It's all about finding the right yardstick for the right part of the business.
Okay, so after all that slicing and dicing, what did they come up with? The comps analysis said Warner Bros. Was worth somewhere between $15 and $21 a share. Wait a second. The deal price was $31. Whoa. That's not just a little off, that's way outside the range. So what gives? Is this a bad deal? Well, not so fast. This is just our first piece of the puzzle.
So that brings us to method number 2, learning from history. This is a bit different. Instead of looking at what similar companies are trading for on the stock market today, this method looks at what buyers have actually paid to acquire whole companies in the past.
This is called Precedent Transaction Analysis. And here's the key difference. The price someone pays to buy an entire company is almost always higher than its day-to-day stock price. Why? Because to get all the shareholders to agree to sell, the buyer has to offer a little something extra. It's called a control premium, and it's the price you pay to take the driver's seat.
And man, they looked at some absolute blockbuster deals for this part. JP Morgan dug through 15 different past acquisitions. You see some of the legends here. AT&T's monster deal for Time Warner, Amazon grabbing the iconic MGM studios, and of course, Disney taking over all of Hulu. These aren't just stock prices. This is what someone actually wrote a check for.
And would you look at that? All of a sudden, the valuation range jumps up to about $21 to almost $30 a share. Now we're getting warmer. The $31 price tag is still at the very top end, but it's starting to look a lot more reasonable. It tells you that the premium being paid here isn't totally out of left field compared to other big deals.
Okay, this brings us to our third and final method. And honestly, it's the most inside baseball of them all. It's called a discounted cash flow analysis, or DCF. And it's all about trying to calculate the value of all the money a company is expected to make, well, forever.
It boils down to a pretty simple idea. $1 in your hand today is worth more than the promise of $1 next year, right? Because you could invest that dollar. A DCF basically takes all the cash a company is projected to make in the future, next year, the year after, and so on, and uses a formula to figure out what that entire future river of cash is worth in today's money. It's kind of like figuring out the lump sum payout for a lottery jackpot.
But here's the catch. To pull this off, you basically have to become a fortune teller. JP Morgan had to forecast Warner Bros.' cash flow out to 2030. Then they had to guess at a perpetuity growth rate, which is how much the company will grow forever after that. And finally, they had to pick a discount rate to bring it all back to the present.
You can see how this gets subjective fast. Tweak any of those guesses, and the final number can swing by billions.
So, with the assumptions they chose, check this out. The DCF spit out a value range from around $20 all the way up to $31.34. And bingo! For the very first time, our $31 deal price lands smack dab in the middle of the range. You can bet this analysis was a huge piece of the puzzle for the board when they decided to approve the deal.
Okay, so we've got 3 different methods, all giving us slightly different answers. So what do you do with all that? Well, you put it all on one page in what the finance world famously calls the football field chart.
And this right here, this is the money shot. This is the exact kind of chart the board of directors is staring at. You can see the 3 valuation ranges all lined up. The comps analysis is way down at the bottom. The precedent transactions get us much closer. And that DCF analysis is what stretches all the way to the top. Now see that vertical line? That's our deal price, $31. It's right at the tippy top of the range, but hey, it's on the field. It's justifiable, especially with that optimistic, forward-looking DCF backing it up.
Now, looking at that chart, it all seems so clean, so scientific, right? Like pure math. But is it really? This is where you have to put on your analyst hat. And remember that even in a $100 billion valuation, things aren't always as precise as they look.
The math seems to check out, but does that mean the valuation is flawless?
You know, as one expert said when reviewing this deal, you have to dig under the skin of these reports to really get what's going on. And when you do that here, you start to notice a few potential cracks in this beautiful-looking analysis.
First, remember those precedent transactions? The biggest, most important one was AT&T buying Time Warner, all the way back in 2016. I mean, think about it. The media world is a completely different universe now. That was before Disney Plus even existed. Using a multiple from a bygone era could mean you're overpaying. Second, and this one is kind of wild, one of the recent deals they used for comparison was the original Paramount/Skydance deal. So they're using a past Paramount deal to help justify the price for the next Paramount deal. You see the circular logic there? And finally, let's not forget the DCF, the analysis that really got this price over the line. It's all based on predicting the future. And let's be honest, who's ever gotten that 100% right?
And all of this leaves us with one big final question, doesn't it? When we see these gigantic, multi-billion-dollar price tags, it's easy to think they came from some perfect objective formula. But as we've seen, behind the fancy spreadsheets, it's a process loaded with assumptions, judgment, and data that might not be perfect. So, what do you think? Is corporate valuation a rigorous science, or is it more of a professional art form? It's definitely something to chew on the next time a massive merger hits the news. Thanks for joining me.